Hi, I'm Jessie Thomas with Henssler Financial. Do you dread opening your mailbox and finding a letter from the IRS? You're not alone. Today I'm going to talk about potential audit triggers and what to do if you are audited by or receive a notice from the IRS or a state taxing agency. During tax planning, I am often asked, how do I avoid being audited? Fortunately or unfortunately, most common audit triggers are unavoidable in the natural course of doing business or preparing a return. The important thing is to keep good records, so that if you are audited or receive a notice, you have the information at hand to either agree or disagree with any changes made to your returns. The IRS runs a computer program called the Discriminant Inventory Function System for each individual return that it receives. The Discriminant Inventory Function System, or DIF, is programmed to look for certain sets of information, including duplicates, income or deduction levels that are far from the median, certain credits, and income levels. If you are flagged, your information will be reviewed by somebody in the IRS and may be audited if the person reviewing it determines that something is abnormal. So, the DIF system kicked out your return and you're being audited. What are some possible reasons? Most common reasons I see returns being audited revolve around self-employment. If you own your own business, you are entitled to more deductions than somebody who does not own their own business. The IRS may flag these returns to be audited, especially if they are cash businesses. If the deductions you are taking for your business stray from the median deductions for your profession, the IRS may examine them to ensure that the deductions are legitimate. If your earnings are far from the median income for the year, you have a higher chance of being audited. If you are on the high end of the median, the IRS or state agency may examine your return with the hopes of finding an issue. This is because they know you are more likely to have an ability to pay additional taxes if your return was adjusted. This also applies to if your itemized deductions were high given your income level. On the other side, if your income was low, the IRS may audit your return to ensure that any earned income tax credit claimed is justified. If you are missing income on the return you submitted, especially from a W-2 or 1099, there is a good chance that you will receive a notice and a chance you may be audited. This is because the IRS receives copies of these forms and knows what should have been earned during the year. Most often, this will cause a notice to be issued, not a full-blown audit. Notices are issued when the federal or state agency recalculates your information and does not come up with the same numbers that were on the submitted return. This may be because you are missing a matched document, payments in your account do not match payments on your return, there was a typo on your return, and many other reasons. Whether you are audited or receive a notice, there are several steps to take to ensure that you minimize or negate any penalties. Number 1. If you receive a tax notice either from the IRS or state agency, review it immediately. If you agree with the changes, send any payments as soon as possible to stop the accrual of interest. If you disagree with the assessment, respond or have your CPA respond as soon as possible, referencing the notice number. Number 2. Keep good records. If you are audited or receive a notice, the sooner you are able to pull documentation together, the sooner you can resolve the issue. Keep records for at least the last 3 tax years. Number 3. Ask for help. If you do not understand the requirements of the audit or notice, contact your tax advisor or call the IRS or state agency. An agent should be able to walk you through what changes are being made to your returns and what your next steps are. I'm Jessie Thomas with Henssler Financial. Thank you for watching.